Investors, I'm here to break some news most on financial TV or in the media don't know or don't want to tell you. What's that? That's American economy is slowing, which is normal after the consumer-led holiday season. However, it's slowing pretty rapidly. As usual, I'll give you a little real-time data as well as warn investors away from focusing on or even believing the short-term government data releases that so many in the media, most of whom have never actually managed money, but rather reported on it, seem to like to focus on. The data is pretty straightforward. Whether you believed in Bidenomics and the prior administration's horribly named IRA spending program nearing $900 billion, it provided a short-term economic stimulus in 2023 and the first half of 2024 in front of the presidential election. While grossly overstated, I'll come back to the real data in a bit. The job market has been relatively good and stable. The unemployment rate has stayed near historic lows over the last 2 years. And while every job counts for our economy, and we would rather have more people employed than less, the types of jobs and the employers matter significantly in the economy's strength. Looking at the data behind the data, the real data that comes out 12 to 18 months after all the revisions and government adjustments, you'll find that the vast majority of jobs over the last 2 years have been in 3 to 4 areas that are not really private sector dependent and instead mostly subsidized by taxpayers. The biggest job gains outside of the service and travel area and leisure sector have come from government hiring, education, which is also taxpayer funded, and healthcare, which for the most part is also taxpayer reliant, as Medicare and Medicaid spending drives so much of our national's healthcare demand and costs. We've discussed for the better part of 15 months the overstatement of the strength of the U.S. job market by the Department of Labor. Once again, we'll reference the tremendous work that Hedgeye has done on this subject. First, job openings, released in the widely discussed JOLTS report, have been revised lower 14 out of the last 17 months. Take a look at the chart on that weakening trend. That while the short-term data, the 221,000 job opening increase showed is a beat on, yep, you guessed it, government job openings, which, as investors know, are taxpayer funded and create little actual long-term economic output. Of the 221,000 increase, 179,000 or 81% were government openings. We really need more government employees for what? Here's the data on the explosion in government job openings and rapidly declining strength in the private sector openings. Over the last 3 years of the prior administration's term, the monthly payroll revisions have been in 2022 from 441,000 to 380, 2023 231,000 to 217, in 2024 from 186,000 to 166,000 per month, with 2024 still having more time to be revised lower. Followers know that I was no fan of Bidenomics. However, as an investor, our job is to ascertain if these policies would help or hurt the economy and stocks. In late 2022, our team thought that even though they were more debt-fueled policies, that they would actually help overall economic growth and earnings in 2023 and 2024 and drive stock prices materially higher as it happened. Currently, the Trump administration is looking to reverse a lot of these policies of overhiring at the federal government level, as well as allowing open borders. While I might agree with these policies in principle, an investor's job is to determine what, if any, effect these might have on our economy and on the financial markets. Currently, the pace and randomness of the policies coming out of DC are creating huge short-term economic uncertainty. Remember, investors, our economy is 72 to 75% service, and whether you think it or not, our federal government is widely overstaffed. Those employees earn a wage, pay mortgages, buy food, goods, and services, and yes, recycle these taxpayer dollars back into the economy. The rapid firing of government employees, while long-term saving taxpayer money, short-term takes consumers out of the market for new purchases. At the margin, they will hurt economic growth that was already slowing and missing estimates due to the trailing off of the IRA fiscal impulse. At the same time, the new administration has changed the tariff rules on 2 consecutive Fridays. Investors and financial markets hate policy uncertainty. Financial markets hate friction, whether caused by actual government actions like higher regulation or higher taxes, or just public brainstorming. Investors, tariffs are friction. Financial markets hate friction. Tariffs are taxes. Financial markets and your stocks hate higher taxes. Right now, whether you like the policies coming out of DC or not, The markets see those policies, be they tariffs, Doge, government employee firings, and even deportation, as friction, and are having a tough time digesting them as they see them all lowering economic growth and hurting, not helping, revenue and earnings of most companies. As always, where we can, we come back to real-time data in the financial markets if we can find it. Longtime Oak Harvest followers know I love to watch real-time real interest rates and real-time real break-even inflation charts, the two components of nominal treasury yields. Here's the one for 2-year real-time real interest rates. Higher for mid-2022 on the back of the fiscal stimulus of the IRA spending and maybe some AI spending in the private sector, and down and to the right, slowing trend since last summer, with that downside slowing picking up since late December of last year, post-election, when the concerns over policies on tariffs, government employment cutbacks, and deportations have taken center stage. Whether you like these policies or not, they are anti-growth in the short term, and the bond market sees it, and the stock markets have started to wobble on their own concerns. Real interest rates are now down and to the right, which means growing but slowing down. It means the risk of a Fed making a policy mistake by staying too tight for too long is increasing. To me, as well as the markets we are watching behind the scenes, the economic risks are not of rising inflation, but rather lower growth rates caused by two things. First, the runoff of the Biden spending from 2023 and 2024, which created a bit of a sugar high, right as the second one, the Trump administration implements fiscally restrictive policies like mass government firings and deportations. Remember, investors, this is not a commentary on whether I agree with any of these policies or not, but rather their effects on the economy and on the financial markets. As we previously mentioned, soft landings in the economy do not guarantee no volatility. This time around, the Trump administration seems to be going for the early shock and awe, which financial markets do not relish. They're attacking tariffs, immigration, and government employment and waste hard from the first week. The economic surprise index is slowing, and an already fragile consumer confidence due to higher inflation under Biden is already stunting economic activity. Seasonally, February does tend to have lower returns, higher volatility month for stocks, particularly the first year of a presidential term, and maybe the tariff actions and the Doge firings are this year's excuse. I don't know, but take a look at the historic data of the monthly seasonality from Steve Supmeyer's data group at Bank of America Securities. Regardless of the path for the economy and the financial markets in 2025, the investment team here at Oak Harvest Financial Group will be here crewing the ship and adjusting our models and tools as we can. We expect 2025 to be a very active year for active stock management. Investors, until next week, have a blessed weekend and have a happy Valentine's Day.